When people talk about small cap investing, they usually say one thing: higher risk, higher reward. If that's true, then an ETF like IWM, which tracks 2,000 small cap companies, should outperform the S&P 500 over the long run. But when you actually test that idea, the results tell a very different story. Using a daily dollar cost averaging strategy, the results are very clear. Over the same period, with the same contributions, IWM finished nearly 40% lower than SPY. Same market, same strategy, completely different outcome. In today's episode, I want to explain why this is not a coincidence, and this is based on real market data and deep research. No hype, no bluff. I'll explain what IWM is and how the Russell 2000 index works, how it has performed versus SPY over long periods of time, the 3 key structural weaknesses that drive that performance, and what IWM is actually suitable for. A quick disclaimer: this video is for educational purposes only and does not constitute financial advice. Without further ado, let's start with what IWM actually is. Before we talk about performance, it's important to be very clear about what IWM actually is. iShares Russell 2000 ETF, or IWM, tracks the Russell 2000 index. As of the end of 2025, the fund manages roughly $74 billion in assets and charges an expense ratio of 0.19%. Liquidity is extremely high, which is one reason IWM is so popular with traders. The Russell 2000 represents roughly 2,000 of the smallest publicly traded U.S. companies. Selection is based purely on market capitalization ranking, with no profitability requirement and no qualitative judgment. The index is fully reconstituted once a year. Each year, all eligible U.S. stocks are ranked by float-adjusted market cap. The largest roughly 1,000 companies go into the Russell 1000, and the next roughly 2,000 companies become the Russell 2000. There is no earnings screen, no balance sheet filter, and no committee review. It is a mechanical, size-only process. The Russell indexes are maintained by FTSE Russell, which is part of the London Stock Exchange Group. While the Russell 2000 is not an S&P index, it is still one of the most widely used and authoritative benchmarks in global equity markets, especially for small-cap exposure, derivatives, and institutional trading. One quick clarification that's important here is that the Russell 2000 does not fully overlap with the S&P 400 Mid-Cap Index or the S&P Small Cap 600. Although they are often grouped together as small or mid-caps, the construction rules are completely different. S&P indexes apply profitability requirements and committee oversight, while the Russell 2000 does not. Because of this, the Russell 2000 should be understood as a small-cap market barometer and a highly tradable benchmark, rather than an index designed to optimize long-term compounding. Once you understand how the Russell 2000 is built, the long-term behavior of IWM starts to make a lot more sense. Now that we understand how IWM is constructed, let's look at performance. It's important to start with a quick clarification. Short-term performance is noisy. Over selected periods like 6 months or 1 year, IWM can look competitive and sometimes even stronger than the market. But these short windows are dominated by liquidity conditions, sentiment, and risk-on or risk-off trading flows, rather than business fundamentals. That makes short-term comparisons unreliable for long-term investment decisions. When we zoom out and look at long-term results using daily dollar cost averaging, the picture changes completely. Over the same full market cycle, with identical daily contributions, SPY delivered an annualized return of 14.64%, while IWM delivered just 9.91%. That gap is very large for 2 broad U.S. equity ETFs, and it compounds dramatically over time. You can see this clearly in the ending portfolio value. Using the same contribution schedule, the final value of the SPY portfolio reached about $162,000, while the IWM portfolio ended at around $103,000. That's not a small difference. It's the result of years of compounding working in one portfolio's favor and not the other. The contrast becomes even clearer when we look at risk-adjusted performance. Over the same period, SPY achieved a Sharpe ratio of 0.90. compared with 0.63 for IWM. On the downside, the difference is even more pronounced. SPY's Sortino ratio is 1.29, while IWM's Sortino ratio is only 0.91. This means SPY rewarded investors far more for each unit of risk taken and offered significantly better protection during market drawdowns. So despite taking on higher volatility and deeper drawdowns, IWM delivered lower returns and worse risk-adjusted outcomes. When higher risk does not translate into higher compensation, that is not a timing issue. It is structural. And once you see that clearly, the natural question becomes why this keeps happening. The answer lies in how the Russell 2000 is built. There are many reasons behind the long-term underperformance of IWM. Some are cyclical, some are macro-related, and some are behavioral. But instead of listing everything, it's more useful to focus on the three structural factors that matter the most. The first and most important weakness lies in how the Russell 2000 index is constructed. The Russell 2000 is built using a pure size-based ranking system. Every year, all eligible U.S. stocks are ranked by float-adjusted market capitalization. The largest roughly 1,000 companies are placed into the Russell 1000, and the next roughly 2,000 are placed into the Russell 2000. This process is fully mechanical and is repeated annually through reconstitution. The problem is what happens when companies succeed. When a company in the Russell 2000 grows, performs well, and increases in market value, it does not remain in the index. Instead, it is removed and promoted into the Russell 1000. At the same time, weaker companies, whose market capitalization has fallen, are moved into the Russell 2000. By design, the Russell 2000 constantly sells its winners and buys its laggards, whereas the S&P 500 retains its winners. This is not a flaw in execution. It is exactly how the index is supposed to work. But from a long-term investment perspective, it creates a structural drag on compounding. The index systematically prevents its strongest companies from contributing to long-term returns, while continuously reintroducing weaker businesses. This mechanism, often referred to as reconstitution drag, means that IWM cannot benefit from sustained winner concentration. Even when a small-cap company becomes successful, shareholders in IWM stop participating in that success at precisely the moment it starts to matter most. Once you understand this, the long-term performance gap we saw earlier begins to make sense. And this is only the first structural issue. The second structural weakness is profitability. And this is where the difference between IWM and the S&P universe becomes very clear. According to FactSet, around 43% of companies in the Russell 2000 are not making money, reporting negative net income in their most recent fiscal year. This is not a temporary anomaly. It reflects how the Russell 2000 index is constructed. There is no financial viability requirement. As long as a company is small enough by market capitalization, it can remain in the index regardless of whether it generates profits. But this is not just statistics. It points to a deeper issue. The fundamental force behind long-term growth in equity markets is earnings. Profits are what allow companies to reinvest, compound capital, buy back shares, reduce debt, and survive economic downturns. Without earnings, growth depends on expectations, liquidity, and sentiment rather than on durable business performance. When nearly half of an index is not profitable, compounding becomes fragile. It can work during periods of easy money and strong risk appetite, but it breaks down quickly when financial conditions tighten. That dynamic explains why IWM often performs well in liquidity-driven rallies, yet struggles to deliver consistent long-term results. By contrast, the S&P 500 is designed to stay competitive. To be eligible, companies must demonstrate strong earnings. If profitability deteriorates or a company no longer meets the index's standards, it can be removed. This constant enforcement keeps the index concentrated in businesses that are actually generating profits. So the comparison is not just about company size. It is about whether an index is built on earnings-driven compounding or whether it allows a large share of unprofitable companies to persist. When low profitability is combined with the reconstitution mechanism discussed earlier, the challenge for long-term compounding inside IWM becomes even greater. The third structural weakness is subtle and not discussed very often, but it has a major impact on how IWM behaves: flow sensitivity. On the surface, the Russell 2000 looks large because it holds more than 1,900 stocks. But when you quantify the index, a very different picture emerges. As of the end November 2025, the average market capitalization of a Russell 2000 company is $4.7 billion. Multiplying that by the number of constituents gives a total index market capitalization of roughly $9.1 trillion. Now compare that with the largest U.S. companies. As of late 2025, NVIDIA has a market capitalization of about $4.5 trillion, and Apple is worth roughly $4.0 trillion. Combined, those two companies alone are worth around $8.5 trillion. That means the entire Russell 2000 is roughly equal to NVIDIA plus Apple, and still smaller than the combined value of the top 3 mega-cap stocks, once Google is included. For additional context, the S&P 500 has a total market capitalization of approximately $58.3 trillion as of December 2025. That makes the S&P 500 more than 6 times larger than the entire Russell 2000. This difference is not academic. It has real consequences. When an index has a total market capitalization of around $9 trillion, it becomes highly sensitive to trading fund flows, large reallocations by institutions, hedge funds, volatility strategies, or macro funds can materially move prices across the index, even if nothing changes at the business level. Flows that would barely register in the S&P 500 can meaningfully impact small-cap valuations. This helps explain why IWM often experiences sharp rallies and deep drawdowns that appear disconnected from earnings or fundamentals. The index behaves less like a long-term compounding vehicle and more like a flow-driven trading instrument. When capital flows in, prices rise quickly. When capital flows out, volatility increases and drawdowns accelerate. By contrast, the S&P 500 is anchored by companies with multi-trillion-dollar market capitalization, deep liquidity, and durable earnings. Trading flows are absorbed far more easily, resulting in greater stability and more reliable long-term compounding. So while the Russell 2000 appears diversified on paper, its limited total market size makes it structurally vulnerable to flow-driven volatility. When this is combined with reconstitution drag and weak profitability, the long-term performance outcome we observed earlier is no longer surprising. After breaking down the structure, performance, and weaknesses, it's important to be clear about one thing. IWM is not a bad product. It's just not designed for long-term investing. In fact, iShares Russell 2000 ETF is one of the top 10 most liquid ETFs in the US market. Daily trading volume frequently exceeds 40 million shares, bid-ask spreads are tight, and the options market is deep and active. From a trading perspective, this is a very high-quality instrument. That liquidity makes IWM well-suited for short-term traders, tactical allocators, and theme-based strategies. A clear example is the small-cap rebound from March 2020 through November 2021, when aggressive monetary stimulus and risk-on sentiment drove strong capital flows into small caps. During that phase, IWM performed extremely well as a cyclical recovery trade. Used this way, IWM does exactly what it's supposed to do. It provides fast, liquid exposure to small-cap beta and responds quickly to changes in sentiment and liquidity conditions. The problem starts when that short-term success gets mistaken for a long-term investment thesis. When liquidity is abundant, many structural weaknesses are hidden. But when conditions tighten, those weaknesses are exposed very quickly. As Warren Buffett famously said, "Only when the tide goes out do you discover who's been swimming naked." In the case of IWM, when the tide goes out, the combination of weak profitability, forced reconstitution, and flow sensitivity becomes very visible. What worked as a theme trade stops working as a compounding vehicle. That's why chasing small-cap themes during hype phases can work temporarily, but it is fundamentally different from building long-term wealth. For investors whose objective is long-term compounding, there are structurally better alternatives. Broad market funds such as iShares Russell 3000 ETF, IWV, or Vanguard Total Stock Market ETF, VTI, allow successful companies to remain in the portfolio as they grow, instead of being forced out once they succeed. So the takeaway is simple. IWM is a trading instrument, not a long-term compounding engine. It works very well for short-term exposure and tactical positioning. But for long-term investors, broad market indexes are far better aligned with how wealth is actually built. Understanding that distinction is the key to using IWM correctly. IWM underperforms in the long run not because small caps are bad, but because of how the index is built. Winners are removed, profitability is weak, and the entire index is small enough to be heavily influenced by trading flows. That makes IWM an excellent trading tool, but a poor long-term investment. If your goal is short-term exposure, tactical positioning, or trading around market themes, IWM can make sense. But if your goal is long-term wealth creation, broad market funds that let winners compound naturally are structurally better choices. Understand the product before you buy it. If you found this breakdown useful, like the video, subscribe for research-driven investing content, and leave a comment on which ETF you want me to analyze next. Thanks for your time today. I will see you in the next one.